The 2023 housing crash might have just been canceled thanks to Jerome Powell and the Federal Reserve. You see, the Fed has a huge influence on whether the markets go up or down, and so the future of the housing market really relies on the future decisions that the Federal Reserve choose to make with their monetary policy. Well, with the most recent data showing signs of the economy starting to slow down, the Fed is already starting to talk about the possibility of a change in monetary policy and a potential pivot taking place, which would of course change the entire trajectory of the housing market. So in today's video, I'm going to break down exactly what is going on in the economy and how the Federal Reserve might have just stopped the housing crash from happening in 2023. But before I get started, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. And with that said, let's jump into it. The Federal Reserve is also known as the Central Bank of the United States, and they've played a huge role throughout the years in the boom and the bust cycles of the financial markets. For instance, if you were just to go back a couple years to the pandemic, many people believe we were headed for an economic recession as we saw a lot of job loss take place, as we saw businesses shut down throughout the country. So to avoid that from happening, the Fed took drastic measures and lowered interest rates down to 0% to make it extremely cheap to borrow money, which would help boost up businesses' revenues, and they went on an all-out binge, spending trillions of dollars to prop up the economy. They spent over $120 billion on treasury bonds and mortgage-backed securities, helping bring mortgage rates down to the lowest levels we've ever seen before in America. The government added even more fuel to the fire by printing several stimulus checks, and in 2020 alone, we printed over 20% of our entire money supply. So because of these drastic measures taken by the Federal Reserve and the US government, instead of experiencing an economic recession in March of 2020 like many thought was going to happen, we instead saw insane economic growth take place across the country, with business revenues soaring and asset prices growing like we've never seen before. Now, particularly in the housing market, we saw some of the highest price growth we've ever seen, with Redfin reporting that by mid-2021 that we were seeing nationwide year-over-year growth at one point of over 24%, and some markets we're seeing well beyond that, with markets like Austin and Boise seeing between 42 to 44% at the height. Now, the problem with this is when you have the cost of borrowing money so cheap and you're handing out stimulus checks, free money across the country, it creates an insane amount of demand for spending, and you're pairing that at the time when we were dealing with some insane supply chain issues as well. So with supply low and demand high, naturally prices across the board started to go up, and we started to create this inflation problem. Think back to the pandemic when toilet paper prices were soaring through the roof, and that was a problem of there was not enough supply to meet the demand. So anyways, this all led to inflation going up to the highest levels we've seen in over 40 years, whereas in June we saw it hitting 9.1% year-over-year growth. So the Fed realized they had to do something because inflation was getting out of control at these levels, and so around March time, before we hit that all-time high in inflation in this cycle, they ended up deciding to shift their monetary policy. A quick interruption for today's video sponsor, Simply. If you're wondering where the housing market is going, if we're heading towards a bigger housing market recession, and how you might be able to use this opportunity to make a lot of money investing in real estate, then I highly recommend checking out this upcoming event by Simply. They're hosting a free live event on their YouTube channel at Simply, but make sure you register on their website using the link below in the description. Now, as far as when the event is taking place, it's going to happen on Wednesday, December 14th at 6 p.m. Eastern Time or 3 p.m. Pacific. Now, for this event, they have a great panel of experts with a lot of experience in the real estate industry, talking everything from the past, present, and future of the housing market to how they're able to use strategies and other ways to capitalize and make a lot of money in real estate investing, even at this stage in the market. So if you're thinking about buying or selling a house, you're looking for for more information on investing in real estate, or you just want to stay in tune with what is going on in the market, then you definitely don't want to miss this event coming up. So make sure you register right now using the link in the description below. And with that said, let's get back to the video. So basically, since March of this year, the Federal Reserve has raised interest rates a total of 3.75%. And that has a huge effect on things like car loans, credit cards, personal loans, HELOCs, as it causes those interest rates to go up as well. It also indirectly leads to mortgage rates going up, which is why we've seen them go up so much over the past several months. Now, why would they want to raise interest rates? Ultimately, what it comes down to is by raising interest rates, it's making it more expensive to borrow money, and it lowers the amount of money that people are spending in the economy. So naturally, the business revenues are going to go down. It's going to slow down business activity, which as a result will bring inflation down, as it's based mostly on supply and demand. So where we're at today is the Fed is actually achieving their goal of lowering inflation better than many experts and investors thought they would. In fact, Jerome Powell just gave a speech this last week, and between the data we've been seeing come back for the economy and what Jerome Powell said, we get the impression that really the Federal Reserve feels like they are winning the war on inflation. And if we're being honest right now, he kind of is winning that war. We saw in October that inflation came down from 8.2% down to 7.7%, which was better than expected. We saw core inflation, which is your inflation not counting your food and energy costs, that came down from 6.6% down to 6.3%, again better than expectations. So this is really the first time since they made it public that they're trying to fight inflation that we're really seeing some serious progress take place. And so that's why we've been seeing some stock rallies take place, why we've been seeing treasury bond yields fall, which have ultimately led to mortgage rates falling as well. Now, going back to Jerome Powell's speech last week, what he had to say specifically is that the time for moderating the pace of rate increases may come as soon as the December meeting. So that's just literally about a week or a week and a half from now, coming up on December the 14th. Now, I do need to point out that the Fed also said they may stay with a restrictive policy for a long time before they end their inflation fight. So when I talk about the Fed pivoting right now, I'm not talking about them doing a full U-turn to where they're lowering interest rates again, they're buying more treasury bonds trying to boost up the economy. Instead, the Fed is slowing things down. They're slowing down their rate hikes and may even pause their rate hikes as soon as after this December meeting, which is why investors get the feeling that a U-turn may be just around the corner, and that's why we're seeing stock market rallies, which is why we're seeing these treasury bond yields fall. So like I mentioned, this is what's causing mortgage rates to come down, and so if they remain low and continue to go lower, which can happen if we continue to see some great progress taking place with inflation, then I believe the housing crash is going to be canceled for 2023. I only believe a nationwide level housing crash will take place if we see mortgage rates go back up again. Now remember, a nationwide housing crash is when we're seeing levels drop over 20% throughout the country. Now, I do believe some areas are definitely going to see those kind of drops, and some are already knocking on the door at this point. But nationwide, I believe that we would have to see mortgage rates get back up to the levels of maybe the 8s, potentially the 9s, for us to see a nationwide housing crash. If you go back to October, mortgage rates hit a high of 7.37%, and since then we've seen them now come down to about 6.3%. So over a 1% drop has taken place, and 1% drop in mortgage rates really equivalates to buying power going up by 10%. So really what it's going to come down to is, number one, inflation. Do we continue to win the war on inflation? And number two, what does the Federal Reserve continue to do with their monetary policy? What I personally believe that we'll see the Federal Reserve do is in the December meeting, I think we will have another 0.5% rate hike, and then they may do another 0.25% maybe in February and then pause at that point. Or the other alternative is they may do a 0.5% rate hike in December and then pause from then on. I think what it really comes down to is the inflation data we get back for the month of November, which comes in on December 13th, right on the day they start meeting. If inflation shows continued progress, I think the Fed continues to dial it back, maybe pausing after the December meetings on their rate hikes. Whereas if it comes hotter than we expected, then I think we'll see the alternative take place. But taking a look at some of the data the Fed is looking really closely at, we're seeing some positive signs of consumer activity declining, which is exactly what the Fed wants to to see. You see, we saw core PCE numbers come back better than expected. PCE stands for Personal Consumption Expenditures, and it basically measures the amount of consumer spending taking place across the country, not counting food or energy. Now, this is a number that the Fed watches very closely, because if that consumer spending is going down, that could be an early indication that with the drop in demand, that could be a sign that inflation levels could also be going down as well. So for September numbers, when we got those back last month, the core PCE numbers were going up at a rate of 0.5% month over month. Now, they were expecting that to drop down to 0.3% for the month of October, but it ended up coming back at 0.2% month over month growth. Now, on the other hand, when it comes to the job side, we're not really seeing the same kind of negative declines that the Fed really wants to see. We saw it drop from 284,000 new jobs down to 263,000 new jobs for non-farm payrolls, but they were really hoping to see that drop down to 200,000 for the month of October, so that was a bit of a disappointing jobs report. So at this point, the Fed is really seeing good results when it comes to consumer spending declining, but they're not really seeing what they want to see as far as their monetary policy having an effect on the jobs front slowing down, and we didn't even see it much on the unemployment levels changing at all. They stayed stagnant at 3.7%. So overall, the future of the housing market really comes down to this war on inflation, and if we do continue to see these levels of inflation go down better than expected, then I think the housing market crash is canceled for 2023. But if inflation continues to be a problem, if that was a 1-month blip we saw in October and we start to see worse numbers come out for November and December, then I do believe that that will trigger mortgage rates to go higher again, in which case the housing crash is back on the table. Regardless, I do want to make it clear, again, markets like Austin, markets like Boise, markets like Phoenix could still well be headed for a crash regardless of what mortgage rates or the Federal Reserve do. But when I'm talking about a nationwide housing crash, that is a whole different story, and that requires more drastic things to take place in order to cause that, and I think that at the current mortgage rates, there's no way that's going to take place. It's going to require affordability to get to even worse levels than where we're at now. So I'll continue to keep you guys updated. We really don't know what the future holds, but we'll really want to stay tuned to what comes in next week as we get that inflation data back, as we see what the Federal Reserve continues to do. But with that said, if you enjoyed today's video and you gained some value today, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. Also, let me know your thoughts or questions in the comments below, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And before you go, if you enjoyed today's video, I'm definitely going to recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.